Hi guys, it's Any, aka the NocTrader, your friendly neighborhood swing trader, back again with another video. And in this video, I'm going to go through the 7-step checklist that I take before considering entering any trade. Let's get to the video. So before I get into this video, you know what I'm going to ask you to do: like and subscribe to this video. Leave a comment below if there's a step that you think that I haven't considered before entering a trade. I've got Facebook, Instagram and Twitter at the NocTrader on all social media platforms. Come on, let's get my follower numbers up. On my Instagram I post some motivational pictures. I'm going to post some up here if you can see it. On my Twitter I go through my technical analysis of all my trades if you want to get through more technical stuff and see what trades that I'm looking at. And on my Facebook, I just repost most of the stuff from the Twitter and Facebook, Twitter and Instagram. So this video comes off the back of I've made a couple of bad trades in the last couple of weeks. If you've seen my Crocs trade and my ASOS trade, which I'll go through in the end of this video, so watch this video to the end and I'll explain to you why the ASOS trade didn't go my way. But these two trades, I wasn't taking into consideration one of these steps, and I'm gonna see if you guys know which step I didn't take into consideration. And which is why I've created a 7-step process that I want to go through every single trade from now on, and to make sure that I've considered every single one of these steps before entering the trade, so that I don't make the same mistake twice. Because I've already made the same mistake twice on 2 trades, and it's cost me a little bit of money where I could have saved myself some heartache. So I've mapped out these steps in 7 easy processes, and hopefully as you see me use them in all the videos going forward, we'll see like a change in the an improvement in the results. So I'm just going to go straight into it and stop talking now. So step 1, chart patterns. As you can see, I've created a chart pattern series of videos on all the different types of chart patterns there are. You can see the link to the videos in the top right hand corner. This is one of the steps. These steps are in no particular order, by the way. So this is a step that I would take before entering the trade. So I'd look at the chart patterns, whether it's a channel pattern, ascending triangle or wedge pattern, whatever pattern it is, and see whether the pattern that is conducive with the type of trade that I'm going to make, whether it's a bullish signal or bearish signal. Looking at the chart pattern. Number 2, indicators. So as you know, I use RSI, MACD, exponential moving average 15-day and 180-day simple moving average. Now these chart patterns are important because they play a big part in as to what direction I believe the price is going in over the long term, which is the 180-day simple moving average, and when I should enter the trade, which is the 15-day exponential moving average. Those dictate how and when I enter a trade. The risk to reward ratio. Now, if you've seen any of my pick of the week videos, you know that this is a very important factor that I take into consideration as to whether to enter a trade. If I believe price of a stock is bullish, but the risk to reward isn't favorable enough for me to enter, then I will not enter it, even if I believe it's bullish, because it's all about taking trades where my risk is minimal and the potential reward of entering the trade is maximized, so that even when I make losing trades, the winning trades overcompensate for these losing trades. So that's why I like to have a risk to reward that's 1.5 or higher. Typically you'll see in my pick of the week, sometimes they can be up to 3 or 4 times. The rewards is 3 to 4 times the risk, but obviously sometimes the price may not actually reach the expected limit. So if you have a risk to reward ratio that's favorable, then even if the price doesn't reach the expected limit that you set out for yourself, you'll still get a sizable profit if the trade goes your way. Now the top-down time frame analysis is something that I do that I already do, and I do religiously. And what that is that even if I typically swing trade on the 1-day 4-hour chart. Sometimes I go a little bit lower. I might go to 2-hour 1-hour chart, but predominantly it's the 4-hour 1-day chart that I base most of my analysis on, and dictates what trades I make. But you have to scope out wider and zoom in. So that means I will start maybe on the monthly chart and see what that chart's telling me, then look at the weekly, then look at the daily, then look at the 4 hours, then look at the 2 hours, and so on. So these when you go from a macro level view of the technical analysis of the price, and then you keep going down into smaller time frames, you can really get a better indication of what the price is doing at different time intervals, and it gives you a bigger scope as to where you think the price is going or what you think it might be doing. So the weekly chart may make you privy to some information that maybe the daily or the 4-hour chart doesn't show. Now, fundamental analysis. Now, I'm a technical analyst, so 90% of my attention is to technical information. So that's indicators, chart patterns, price action. But fundamental analysis, is very important, because even when it comes to swing trading, stuff like earning reports or news about the company can throw the price off of its trajectory and make it break pattern. So to be in a flow, to knowing about the fundamental and having fundamental understanding of what's going on with that stock can help you to know when to maybe cut your losses or to exit a trade early, if, for example, if an earnings report's coming. Price. This is important because I tend to not trade penny stocks. That's not a hard and fast rule. Sometimes I might trade them, but for the most part I don't trade them because they're easily manipulated, and they normally don't follow the conventional patterns that more established stocks do. So the price of the stock or ETF in question can dictate whether I'm even interested in trading the particular stock or ETF. So I try to keep it above about £5 or $5, but this is not a hard and fast rule, and you might see me trade some cheaper stocks, so don't hold me to this, but it's just by a case by case basis. And liquidity, similar to the reason for price, liquidity is important because if a stock has a low liquidity, it may not affect me entering or exiting the trade as I spread bet, so I'm not buying the underlying asset. Stocks with low liquidity can often gap up or gap down very volatilely, with a lot of volatility. Sorry, and this is not something that I like seeing in a stock because they can become unpredictable at times if liquidity is low. So I tend to stay clear of really low liquidity stocks. So these are the 7 steps that I'm going to be making sure that I stick to from now on when I enter a trade. And I'm going to go now to ASOS, and I'm going to explain to you why I've actually mapped out these 7 steps, and I'm going to try and stay true to this with every trade that I make now, and go through these. I'll show you in the next video now. Cheers, bye. So I'm back again. This is ASOS. If you look at my last pick of the week, for what date was it? The 17th of March 2019. Once again, link to it in the top right hand corner. I said ASOS was a stock that I was looking at, but it wasn't going to be my pick of the week because I wasn't 100% sure yet on it, even though it had all the signs that I needed for me to go long on it. So I did go long on it, but I didn't promote it as my pick of the week. And what happened was I entered at 3,000 for £1 per pip, and it went up as high as to 3,208. So that means I was £200 up. And yesterday, I don't want to date this because people might be watching this at different times, but today let me go into a short time frame. So look what happened. When the market opened on Tuesday the 19th of March, it broke pattern. For the most part, it was going up. It was just channeling up. It broke pattern and it dropped almost, I don't know how many pips it dropped. It dropped on market open. It dropped 320 pips. Now I'd set a stop loss, so I only lost about 25 £25, but I went from £200 up to £25 down in a flash of a second. Now the reason behind this was that ASOS had I think it was a quarterly earnings, and they were projected to that they weren't going to do well this quarter again. So this is the second quarter. They had bad reportings on their 2018 annual report, and they had also had bad reports again of that sales were slowing down or something like that. I'll post the article up on the screen now. But anyway, this information killed the pattern. Now I could have, if I was privy to the fact that news was going to come out about ASOS on the 19th, and this information was widely available. Not what was going to, the information as to how they were doing wasn't widely available, but there was information coming out. It was widely available that there was information coming out about the company on the 19th, but I wasn't privy to this, and that was a mistake on my part. If I had known this, I would have exited my trade here, because for all I know, it's a bit like earnings report. You never know what this information could be. It could be great and it could spike up. It could be bad. It could spike down. It could be great. It could spike down still. You never know what's going to happen. So I would have exited my trade for a £200 profit and cut my losses. But I didn't check the fundamentals, and that was my own mistake. So from now on, that 7-step process is a process I'm going to be taking through all my trades. It may end up making some of my pick of the week videos maybe a little bit longer, but it's better for me and it's even better for you guys, because fundamental and technical need to work hand in hand, even if for technical analysts, because something like this can happen where I did everything right in regards to my own strategy and it went well, but the fact that a fundamental something fundamental happened to the stock, like a bad report, caused it to drop 300 pips and kill my trade. So you just need to try and avoid things like these. It may end up even recovering, but as I said, it's just, we want to give ourselves the best opportunity to get the trades right. So that's why those 7 steps are there. So yeah, this is just a short video that I was going to make on these 7 steps, and this is kind of the reason behind it, because this broke pattern, and then this happened again with me and Crocs in the previous pick of the week, where I held it through earnings and then it dropped and it broke pattern. So going forward, when I do a pick of the week, I will make sure that the fundamentals are also outlined, just so that we know when the next earning report is, or the next press release that's important to that company is, so that there's no information that we're not privy to that could change the motion of the price. So anyway, that's just me, NocTrader, signing out.